Okay, thanks everyone for joining us today for the Revolution Asset Management Private Debt webinar. My name's Andrew King. I run distribution for Channel Capital, who's Revolution's distribution and non-investment service provider. The purpose of today's webinar is for Revolution to provide just an educational market update on Australian and New Zealand private debt. Just a few housekeeping things to get sorted. So we're going to kick off for about 25-30 minutes with Bob Sahota providing the market update with a few other things. Bob will run through the agenda shortly. Following that, we'll have a bit of Q&A. So everyone is welcome to put in Q&A into their portal that you'll see in the Zoom webinar, and we'll get to those. And those questions that we don't have time answering, we'll certainly ensure we get some responses to you within the next couple of days. For a quick background on Revolution Asset Management, Revolution are headed up by Bob Sahota, CIO, with over 27 years in the market. Bob is actually widely considered one of the most experienced private debt portfolio managers in the country. Prior to joining Revolution, Bob was head of fixed income at Challenger, where he introduced private debt as an asset class in 2005 and subsequently managed the first institutional mandates in Australia on behalf of some of the country's largest super funds. Prior to that, Bob was also a portfolio manager at PIMCO in Australia and California and AMP Capital. Bob's also joined here by one of his colleagues and senior portfolio manager, Dr. Simon Petrus. Simon, with over 18 years experience in the market, is a PhD in applied maths and an asset-backed securities specialist. Prior to joining Revolution, Simon managed multi-billion-dollar portfolios in ABS for an internal balance sheet fund of Westpac called the Credit Relative Value Fund. And prior to that, he was also an ABS portfolio manager with Bob at Challenger. The third senior member of the team, who's not here today, is senior portfolio manager David Sager. David was previously Bob's senior credit analyst at Challenger, where he led the internal credit analysis of leveraged buyout deals, property and infrastructure debt. Now, before I hand it over to Bob, I'd like to point out a couple of very important aspects that I'm sure some of you agree with. When we went about partnering with a manager in the private debt space, we'd been doing a lot of work on the space for a number of years. What was most important to us at Channel Capital, and more than likely what should be most important to you as investors, is the experience and credit discipline to manage through a full market cycle. Bob Sahota, from our knowledge, is the only portfolio manager in the country to have managed institutional portfolios in this asset class through the GFC. And I think what you'll find is it's this experience that speaks to the philosophy behind Revolution's investment process and approach to the asset class. I'll now just quickly hand it over to Bob to kick things off.
Wonderful. Thank you for that kind introduction, Andrew, and welcome everybody to the Revolution Asset Management webinar on private debt. First and foremost, we want to hope that you're all safe and well, and we're all going through some extraordinary times. We hope your colleagues and your friends and family are safe and well. We like to do these sorts of sessions 2 to 3 times a year, and we've had to move obviously this to an online forum. But as Andrew mentioned, we're very heartened by the some 150 plus registrations and being able to talk to people both in Australia and across the Tasman. We want to say thanks to all of you. First and foremost, thank you to all our investors who have joined the webinar. We want to thank you for your support to date, and also for the prospective clients who have joined and people who are generally interested in the private debt space here in Australia and New Zealand. It's actually not a very well understood asset class and doesn't get all that much fanfare and attention. So I think the numbers on the webinar sort of prove that people are interested in the asset class, and we're very happy to present our views and our outlook on the asset class. So turning to the agenda for today, we've got first and foremost the key focus for what we define as private debt for Revolution Asset Management, and the reminders of the sectors that we're focused on. Secondly, what our investment philosophy is, and that's really important in the way that we construct portfolios and how we weather storms like we're currently experiencing with COVID-19. which I think is a very interesting way that we've been able to navigate and really going forward. The current opportunities that are in this dislocated market, this is a playbook that I saw in 2008, 2009, where you can actually take advantage of some amazing opportunities if you've got patient capital, and that's really key in these sorts of markets. We'll also cover off on our current portfolios, the two funds that we've raised and are managing, current performance and current progress on those, and then sort of finally covering off on an outlook for the sector. So with that, let's move into the body of the presentation. So this slide is really one that we use to distinguish what we define as Revolution Asset Management's key focus areas. It's really in three separate asset classes. And first and foremost, we've got this on a risk and return spectrum where there's various different strategies that all neatly fit within an overall umbrella definition of private debt. So it's not a homogeneous asset class. So we take great pains to explain what we actually mean by this. So you'll notice that real estate and senior real estate lending is at the lower end of the risk-return spectrum. That is because we take a very disciplined approach on real estate lending. We really define ourselves and set ourselves apart to our peers on what we don't do. So we don't do speculative construction or development loans. We don't do financing of apartments off the plan. We don't lend to foreigners. What we do focus on is very much cash flow-based shopping centres, commercial office and industrial properties with good quality tenants, and we use the cash flow to really instruct us on how those particular debts are repaid, rather than just selling the property or relying on a valuation. That's really key when potentially we can see quite dramatic differences in valuations in this period. In fact, to date, we've only done one particular real estate lending loan, having seen literally hundreds of loans presented to us. It's because of the credit discipline that we've been able to say no to many of those, and only one has got through our credit disciplined approach. The second area is private company and leveraged buyout deals. This is where we're a syndicated lender to the larger private equity firms purchasing some really large companies. Examples of these: Arnott's Biscuits, a 150-year-old company that was acquired by KKR. Healthstaff Hospitals acquired by Brookfields. MYOB acquired by KKR. And Genesis Care, that again is the leading provider of cancer treatment. These companies have been acquired by private equity, and we form part of a consortium that provides the senior secured debt to those acquisitions, having taken security over those operating companies, and then basically providing the top end of the capital structure in acquiring those companies. The third area, which has become quite an interesting one, is asset-backed securities. This is where we are less reliant on the actual non-bank originators, be they mortgages, credit cards, personal loans, auto loans. We are lending against the particular loans in pools, in special purpose vehicles, and we really have backed in our funds the more established players in this asset-backed securities universe. Household names like Pepper, Latitude and Bluestone that were all in one shape or another acquired by private equity firms over the years. As we've seen the market share move from being dominated by banks to then non-bank lenders starting to take more and more market share from those established banks. This particular strategy is determined not by the last couple of years that we've been established Revolution Asset Management, but it's a strategy that has actually been in place for 15 years. And relative value really determines across these three asset classes in coming up with our overall objective of 400 to 500 over, or 4% to 5% over the cash rate is our return objective. The overall return is determined by which of those particular areas and sectors offer us the best risk-adjusted return. So in that way, this is a strategy that's stood the test of time and has actually been tested through the GFC and beyond. There are some higher risk return sectors that we've called out here, including venture debt and construction debt. special situations and distressed debt, and even lending to bilateral small to medium enterprise SMEs. These are not part of our remit. They are much higher risk return than what we are targeting, and we basically are not involved in that because of what I'll go on to talk about is our core investment philosophy on the next slide. So turning to what our investment philosophy is, and again, this is really informed by having been managing portfolios in private debt through a full market cycle. We at Revolution Asset Management are firmly focused on capital preservation being the core. We've been very vocal, and a lot of our literature that we've been providing to clients and prospective clients when we, right from the beginning of our journey at Revolution, has been about the fact that we felt like we were in late cycle, and that the bull run that had been in Australia for some 28 years, we were due for some sort of correction. We obviously didn't predict the impact of a pandemic, or certainly didn't see that coming, but we knew that there would be some level of correction coming, and really the idea then is to exercise prudence and capital discipline in originating assets, particularly in the debt sphere. Remember, for a lot of people who are focused on equities, it comes as a bit of a surprise that in what we do is the best we can ever do is get our money back for our clients. So we don't have any upside. So our view was that we weren't compensated for some of the deals and some of the industries and sectors where potentially people were chasing a bit more yield, that was not being compensating for the amount of risk. So the other key thing about what we do is we have a very strong income focus. So our philosophy and our strategy does not rely on trading gains to generate returns for our investors. It is pure income, and we'll talk about more about the way that in this market income has become extremely important and not an easy thing to come by in many asset classes. We benefit from being secured. So in every one of our transactions, we have security over an operating business or assets. And then many times we've got the benefit of covenants. So should there be any underperformance, we have the benefit of having some early triggers that we can actually effectively cause us to get our money back, or allow us to get our money back should there be underperformance. So with that as a philosophy, our high credit discipline meant that coming into this sort of crisis that we see ourselves in today, we've actually avoided some pro-cyclical industries. So industries like retail, hospitality, tourism, mining, property development and construction, and early startup fintechs in the asset-backed security side were all areas that we saw deals, and all these deals were done by someone out of the market or groups of people out of the market. We all respectfully declined those deals because of our core philosophy. In fact, our deal approval rate has been around about that 18%. So we're turning down more than 80% of deals that we see, and we haven't been involved in chasing yield just for the sake of that, because at times like this, you really understand credit discipline. So then what are the industries that we have been focused on, and where are our key overweights? So we've been quite highly concentrated in healthcare. And examples, as I mentioned, Healthscope, Healthy Care. Consumer staples like Arnott's Biscuits has actually been a net beneficiary of a lot of the grocery activity and people buying a lot of this stuff ahead of the crisis. Infrastructure services companies, again, very resilient to the cycle and recession-proof. Mission-critical software like MYOB. And then really backing more established asset-backed security sponsors that have been repeat issuers into the capital markets, like Pepper, like Bluestone, like Latitude and FlexiGroup. Are great examples of companies that we've helped finance in a very high risk-adjusted return for the benefit of our clients. Turning to the next slide, we are asked often in this current market, what are the opportunities? So turning to the opportunities as a result of the current crisis, we want to point out that we are not a distressed debt manager, and therefore we are not looking for investments like buying virgin bonds when they're in voluntary administration. We are buyers of performing assets, however, that are in the hands of distressed sellers. So what we mean by that is a number of our peers and their structures that they've got for these types of investments and illiquid investments, where they've offered up, periodic liquidity. These guys have suffered from, potentially redemptions and being forced sellers, as a result of people repositioning their portfolios or just moving to cash. In that respect, they become forced sellers of otherwise performing assets. So this slide we talk about on each one of our different sectors, what were the yields, which are these bars, in a normal market pre-COVID. So for instance, in leveraged buyouts, the average yield was 4.5%, for real estate around 4% and what we target, and asset-backed securities in the BBB rated assets was 5%. But we can see now in the current market, because of this forced selling and not many people that have got either the skills, the experience, or the actual mandates in terms of patient capital, we've been able to purchase some amazing opportunities out in the market because of the fact that we've got dry powder in these markets. And what we've got in the next couple of slides is some really great examples to bring these to life. But it's suffice to say that we're getting to a minimum of 1 to 1.5% of additional yield in each one of our three sectors as a minimum in otherwise performing assets and assets that are not affected by COVID or not likely to be affected by COVID in our expert opinions. So that's I think the key there, and then we can go into the actual physical examples of a couple of deals to bring this to life. This particular company is a leveraged buyout loan. The particular company, we've had a history of lending to this company since 2015. We've got a position in both Fund 1 and Fund 2 in this particular loan. It is basically Australia's leading provider of telecommunication services and infrastructure services. Very resilient, non-COVID affected markets where they have effectively told us that they're very minimally impacted by any of the current dislocation. We were able, because we've followed this company, we own an investment on the private side in Fund 1, so we're monitoring this particular company very closely. We were able to purchase in the secondary market a piece of this debt for our Fund number 2 at a market price of 86.5 cents in the dollar. And instead of a yield of 3.5% or just over 3.5% originally, that yield jumps up to 6.93 at that discount. So that's exactly the same credit, same senior secured position, same terms and conditions. And again, they've got some really good attributes about not being affected by COVID. The company leverage is only 3.2 times from a debt to EBITDA standpoint. It's got a rating by S&P and Moody's of BB and Ba2, and it's got 6 years left to run. So this is a great example of not a stressed asset, but a distressed seller who's able to take advantage of our bid, and we able to really take advantage of that opportunistic purchase for the benefit of our clients. The second example is an asset-backed securities example, where this is quite an interesting one, and one that I really want to highlight, that in normal markets we would not be in a position where we could really be interested in a AAA rated investment. This is in particular a AAA rated security by S&P and Moody's. We would not be interested because it doesn't hit our hurdle of 4 to 5% over the cash rate. This particular bond and note actually has an original yield of 1.65, so you can see well below our target return. But what we've got in this particular market is, again, a forced seller. So going into a little bit of detail, this is a residential mortgage-backed securities pool that's been originated by one of the larger non-bank originators in Australia. But it was owned, this particular position was owned by an offshore fund, one that was probably more of a motivated seller than we expected. We've got extremely robust attributes to this particular bond as is supported by the AAA ratings with 34% credit enhancement. What we mean by that is effectively below this AAA note, there's 34% of subordination that sits below this particular position. And you add to that the robustness of it, which is that the loan to value ratio of the underlying mortgages is on average 69% across 1,200 separate mortgages. And the seasoning we mean by 30 months, which is these mortgages have been going for on average 30 months. So they've been well-performing mortgages over a long period of time coming into this crisis. So we were able to buy this particular note at a 10% discount to par, which then firmly gets us into, above our target yield of 400 to 500 by basically getting to a yield of 6.5%. So you can see there the risk-adjusted return here of a AAA rated asset-backed securities position with a yield of 6.5% gets us back to deals that were even better than what we saw in 2008 and 9, where the markets were severely dislocated. This is higher yield than what I was able to do in my old shop, where we were able to buy AAAs at 450 over. So this is a wonderful example of what are the current opportunities abound if you've got dry powder and you've got a mandate to do it. So turning to the actual funds themselves and a few stats that we can go through. The Revolution Private Debt Fund number 1 was established at the end of 2018, so it's got some 15 months of track record. It is a closed-ended fund whereby we raised $205 million. You can see there, as I mentioned, relative value determines the portfolio composition. It's dominated by asset-backed securities and leveraged buyouts, as we didn't see many deals that fit our criteria in mortgage in commercial property, as I mentioned at the top of the call. We're joined on the webinar by a few of our investors in New Zealand and prospects in New Zealand. We see us as being operating on both sides of the Tasman. New Zealand, for many reasons, is a very attractive destination for our capital, as well as to raise capital. It's because it's a very similar jurisdiction to Australia. In fact, the same banks operate in New Zealand as they do in Australia. Their subsidiaries are in New Zealand, with those banks occupying even larger market shares in New Zealand currently. But that's all going to change as the non-bank lenders are starting to gain market share from those banks. And we see our capital assisting those non-bank lenders to gain that market share advantage. And we've done a number of deals, and you can see there 22% of our fund is actually invested in New Zealand. So we see some great opportunities continuing in that space. The average credit rating for the fund, we originally targeted BB, and that's exactly what we've got in fund number 1. The performance of that particular fund, you can see there, we as I mentioned, our target is 4% to 5% over the RBA cash rate. We're actually performing ahead of that target currently. We've got the fund is returning since inception 6.64% before fees and 5.55% after fees. After fees.
No, that's active.
The active return before fees. So the yield to maturity here is 5.62%, and we've got 24 separate investments in that fund. The credit duration is 2.4 years, so we're not lending long-term in these particular portfolios. We're not lending out to infrastructure 10, 20 years. These are, again, fairly short. The deal approval rate I mentioned is 18%, so we're still turning down many, many deals. We took 12 months to deploy this fund. We originally said 12 to 18 months to deploy this, and within 12 months we've been able to actually put that fund to work. The other thing that I point out, and I think I mentioned it, is all of this performance is income. So it's not predicated on any trading gains, any benefit from duration movements. So all of this is basically income that we distribute to investors on a quarterly basis. And the most recent month, you can see, has been active return before fees of 45 basis points. Again, quite stable and solid in the face of many other asset classes that are suffered in the last month as a result of COVID. Fund number 2 was established at the end of last year, on the 27th of December last year. You can see there it's got no real estate exposure at the moment. Again, leveraged buyout deals as a result of the momentum that we built on Fund 1 is a large part of that portfolio. ABS we expect to grow, and in fact real estate could become a much more interesting opportunity for us going forward as banks move out of that area, as they're more focused on other areas of lending. Again, New Zealand is already featuring in this fund. But the really interesting thing about this slide is, because of those opportunities I mentioned, this fund has got more of a allocation to investment grade. So you can see that in the AAA and the single A allocations. So we've been able to actually generate the return, which I'll get onto on the next slide, with actually less risk, i.e. higher credit ratings in this particular fund, which is a great feature. So turning to the performance for this fund, it's only a short performance period, given we kicked this fund off in December, but already the yield to maturity that we've been able to generate is 5.45. And really the key stat here is already deployed 63% of the 182 million, and at the moment it sits at 185 million in terms of this fund. The key difference between our two funds is this particular fund is open-ended and is able to accept capital on a monthly basis. We formerly had it on a quarterly basis, but we've been asked by a lot of our client base to be able to have monthly capital injections into this fund. So we've recently amended the IM to allow that. And that rate of deployment has really been as a result of the opportunities that I spoke of earlier on. And it's a mix of institutional clients, high net worth and family offices that have been in the fund and continue to support. We've got nearly $70 million of dry powder currently in the fund, and we look to utilise that in extremely attractive risk-adjusted return positions. Before I go on, I've been reminded about our co-investors. So apart from our two funds, we also have a relationship with a global investment bank headquartered in Wall Street, whereby we've been selected as their preferred originator of assets of the ilk of what we're originating for our own funds for their own balance sheet. And to date, we've put to work for them in the order of almost $100 million, whereby they come in alongside our fund investors to allow us to be more influential in the market and actually get to a $40 to $50 million per deal basis on that. So it's been a great relationship for us, and also one that benefits all of our investors. Lastly, on the outlook, before we turn to any questions from the participants, it's really important to understand that patient capital is really important in times like this, particularly when you've got the underlying investments that are illiquid. We feel as though the structure of our funds are well set up to be able to deal with the current crisis. Also, the fact that I've talked about income being quite an important feature, and one that we can actually point to as being one that still exists in this asset class, when traditional fixed income, as a result of rate cuts and base rates being extremely low and historically low, this is an asset class that still produces periodic and stable income. And that in that way, we're able to generate higher returns with less risk, and that's really as a result of the dislocation in the current markets. And this presents a wonderful opportunity for our existing as well as prospective investors to be able to take advantage of this, and we look forward to engaging with you guys once we're out of this on a one-on-one basis and taking your questions at this point.
Thanks, Bob. I think we'll kick off the Q&A. I've got a lot of questions that have come in via the portal, so I'll kick one off that I know is fairly important to quite a lot of people. We have a lot of institutions on the call today, so I know it's important to them first and foremost, and others as well. But can you tell us how you view fees? I guess this asset class is an asset class where you see a mix of approach to fees, some having performance fees and some not, and then some having sharing of upfronts and other things like that. Can you give us a little bit of colour on how your philosophical approach to charging fees in private debt? Sure,
Andrew. So on fees, we take the view, and it's a very philosophical one, in an asset class where, as I mentioned, the best we can do for investors is get their capital back on a particular investment. So there is really no particular upside. So in that respect, we charge a flat management fee on deployed capital. We also don't believe in performance fees for an asset class, again, that's capital stable, because what you end up doing with performance fees is having an incentive to take on additional risk to reach for that additional yield, where the manager actually gets the share of that performance fee. Also on upfront fees, we see these being intrinsically the part of the return of the investor that makes with their capital. So the economics of any deal, generally speaking, in private debt, you gain upfront fees. These are application, structuring, arranging fees. They call a myriad of different things, plus the running margin. These two things make up the overall return to our investors, and therefore we pass all upfront fees to our funds in their entirety.
Great. Another question we've got is about, I guess a lot of investors in this market, you know, taking into account the first point of call for a lot of people is credit discipline. Can you also talk through how important maybe restructuring and workout experience is in the context of what you think is coming with regards to potential corporate defaults and things like that for those that are already investors in private debt, maybe not through yourself, but through others and those sorts of things?
Yeah, so we go to a lot of effort to make sure that we run downside scenarios and look at, you know, what can go wrong in every particular deal and run scenarios that we're currently facing, although COVID is quite a unique one with some businesses almost stopping operations overnight. So that's quite a difficult one to, you know, forecast and model. But we do end up in situations, you know, and I have in the past where, you know, external factors have affected a very good credit and a good company. And then the experience that I bring is, the fact is that you've got, you know, covenants that can come to your favour to provide you early triggers to bring management and sponsors back to the table. You've then got the fact that you're senior secured, so you've got security over the company and you're senior in the capital structure, so that all the equity that sits below us, or even second lien debt that sits, you know, subordinated to us, it all acts as a shock absorber before we lose any of our capital. But in those particular instances, it's important to actually come up with a solution that allows us, under reasonable scenarios, to get our money back. And I've got a number of examples whereby, you know, these sorts of covenants and the fact that you're secured has led us to get all of our money back when, you know, private equities, you know, positions have been eroded and in some cases lost completely, but we've still been able to get our money back. And that's the beauty of being, you know, senior secured in the capital structure.
Thanks for that. A question for Dr. Petrus. Simon, I guess within the you know, assumption in the RMBS market, so the mortgage-backed securities and ABS, can you talk through the way you look at risks of you know, defaults or those not meeting their debt obligations, and how you look at that from a risk perspective, and then maybe, you know, the portfolio and how you guys structure the warehouses that you participate in to protect yourselves from those sorts of things?
Yeah, thanks, Andrew. Yeah, I'll just say that, you know, we didn't anticipate COVID-19 coming, but we like to, every investment that we make at Revolution, we do, you know, stress these as if they're going to go through a very severe downside, you know, recession type of scenario. So we didn't predict it, but we were definitely prepared for these sort of experience. So with an RMBS transaction, you know, to suffer any losses, you need a combination of increased unemployment as well as house prices falling, and, you know, potentially we are going to experience this going forward. But I think that the key point is we've adequately stressed and prepared and made sure that there's a significant sort of equity buffer below us in all our transactions to be able to get through this sort of experience.
Great, thanks, Simon. A couple of other questions I've received, I guess, is looking forward, Bob. Yeah, are you likely to see, and do you think we're going to see continued corporate defaults even with government intervention, and maybe how has government intervention affected, I guess, all the sub-asset classes that you guys focus on with regards to the asset class in Australia and New Zealand? There's a lot of talk that, you know, obviously the government intervention has helped the non-bank lenders, and you know, people are talking about solvency of the non-bank lenders and that sort of thing. Can you talk through your views on that space?
Sure. So we've been heartened by the very immediate and unprecedented support both, you know, the Australian government and the New Zealand government have actually provided in terms of the amount of fiscal stimulus that we've been able to witness in the market. I mean, $200 billion for a government that was very focused on a surplus at one point and was fixated by that is quite a turnaround. We're heartened by that, and we feel as though we have got a position where a lot of people are going to be seen through the next little while, but it's not going to insulate some companies and some businesses and some industries having a semi-permanent or permanent impact on this. Some examples, will commercial office have the same sort of demand going forward when people have started to get very used to working remotely, is one example. So that could have a very strong impact to what the rent levels and lease levels are, and in turn the valuations. Retail space in discretionary shopping centres. Cap rates were at all-time lows coming into this crisis. We expect that cap rates are going to expand quite dramatically. We like grocery-backed centres, and the one position that we have has actually traded quite well through this period because it's within its catchment a very dominant shopping centre backed by a Woolworths and Big W. But going forward, high-end discretionary shopping, a lot of that could be done at the comfort of your own home. So again, there could be downward valuation movements in those sorts of asset classes. Equally, industries like passenger cruise lines. What will be the lasting impacts of that? Tourism looks like it might be one of the last sectors that it might recover. Retail is a big part of our sectors in terms of this country. Foreign students, what will be the impact of that going forward in higher education sector? So all these sorts of industries have been shaken up, and we're not sure how it responds. So we expect that we are going to get a pickup in defaults as a result of this, despite the government's best endeavours. And that's why I think our focus on very resilient, recession-proof industries and businesses has been a key focus.
Great. Just getting on to some of the last questions. There's quite a few here.
We've had a number of questions come through on valuations, and look, the way that we have set up our business very early in the piece was to say that we've got, first and foremost, the structures which are more medium to longer term investment holds. We also have patient capital, and we adopted a credit and valuation policy that said very clearly that if an asset is a performing asset, we will value it at par plus accrued, should that continue to be a performing asset. The only time we deviate away from that valuation is if it becomes a non-performing asset, in which case we go to a recovery rate type of analysis. This is all independently verified on a periodic basis by an independent valuation firm, and that is signed off by them to look at how each and every one of our positions is performing. Now, we take a view that is the prudent approach for a longer term horizon in terms of investments on the following basis. Unlike infrastructure equity and real estate equity, where it really relies on the individual holders of those investments on when they exit, so there's no finite end date, it probably is more prudent for them to value them down in the case where we've currently find ourselves in. We have a different asset class where we've got a legal final maturity date for every one of our investments, and if they continue to perform, be it in a COVID environment or others, that we will get all of our principal back within the period of the loan term. And therefore, we feel justified in saying, well, if it's performing, we will mark that asset at par plus accrued. We're not trading this, and we're not offering daily liquidity, and I think that's where some of our peers might come unstuck, is mismatching that particular capital and having people trade on a NAV that may not be the correct NAV. So we've thought about this long and hard about how we established our firm, and this is the view that we've taken on valuations.
Yeah, I guess that probably speaks to one other question is, people ask, okay, so you're getting deals at 90 cents in the dollar of what you call money good, non-distressed assets, but there's a distressed seller. Do you want to run through that? Because I know that, as investors, there's a lot of investors that have access to global fixed income products that are daily priced. And what are you seeing on that in terms of finding these secondary deals where the underlying deal isn't distressed itself; it's actually a forced seller.
Yeah, and that's part of the presentation was we are definitely not a distressed debt manager. There are very, very good quality managers out there that are purely focused on stress and distressed debt. It's a very different way of actually investing than saying we are going to buy this investment and hold it to maturity. Typically, a distressed debt guy wants to go in and buy something out, or her wants to go in and buy something at say 60 cents on the dollar in a stressed position because they feel on a recovery rate they might get 80 cents. We take the view that we are going to hold this investment till it repays or to the legal final maturity date. And in that respect, that instructs what type of investments we make. Having said that, there are quite often cases in the examples I went through where it might be an offshore holder of these investments where it's not their core remit to be purchasing Australia or New Zealand assets. And in that respect, there could be the first things that they look to sell because they possibly aren't as close to the credit as we are.
Or they own it on repo on margin and they've been margin called is another reason why these guys are selling.
So repurchase agreements is when they effectively are back leveraging those positions with a bank. Now, the banks are probably not in a position where they want to have too many of those sorts of positions. So in the way that you may get margin call for equities, these guys are potentially having their hand forced to sell as these banks are calling those lines in. So again, that AAA example was one where exactly this repurchase agreement meant that we were able to purchase that deal for a AAA deal at a really high yield of almost 7% for a money good asset. Again, no way, shape or form stressed. One question that came through was about line fees. In fact, I can answer that by saying, are line fees passed through to investors? I can answer that by saying all fees in any transaction, be whatever you want to call it, all fees are passed through to our investors in full.
That brings us to an end of the conference and the webinar. I'd like to thank everyone for attending today, and obviously any questions you have, please feel free to send them through to us. We've got a number of these questions in the webinar portal that we'll send through as well, and more than happy to take one-on-ones with any investors that want to get in touch with us. Really appreciate everyone for attending during this period. We've had over 170 or 180 attendees register for this. I hope this is insightful, and we look forward to speaking with you soon.
Thanks everybody, and appreciate your time, and stay safe everyone. Thank you.